Hello, welcome back. Well, let me pop now to screen view and we'll pick it up from there. Okay, so let's jump into handout 13b, which is more on probabilistic measures of risk. Specifically in 13b, our focus is going to be on correlations among mostly stock returns and how correlation is used to build diversified portfolios of mostly stocks and to understand how individual stock returns compare to overall market returns. Okay, so in this chapter, we're going to be looking carefully at portfolios of financial projects. So far, we've been focused pretty much on evaluating, on the one hand, individual financial projects. So, for example, we've been looking at something like buying one stock or bond at a time, making one loan to one home builder, that type of thing. Or on the other hand, we have sometimes looked at portfolios of projects, but really without regard to the interactions of the individual components within the portfolio. So some examples we've looked at already would be something like buying shares of the SPY exchange traded fund, and that includes 500 stocks in it, or buying shares of something like the SJNK ETF, which includes 100 high yield bonds. So these are portfolio projects, but we haven't really thought about how the individual components may affect the overall performance of the portfolio itself. So now, like I say, we're going to be looking closely at the behavior of portfolios of projects and addressing in particular two things. First is how diversification among the individual components of a portfolio can help improve its performance. And on the other hand, how to measure diversification among the individual projects in a portfolio. So let's do a quick review to help get us started on the variability or risk of returns of an investment or a project versus the investment type we're looking at. So what I've got here on the x-axis is I've got, say, annual return of an investment under consideration. So this is in percent, so this would be minus 50%, here's 0, and that's optimistic, 90%, that's nice. And these are going to be here probability distribution graphs. So on the y-axis, I have my probability in percent. So let's start by looking at a very simple investment like buying a treasury note. That would be a treasury bond investment that matures in a year. So back in the good old days, around the end of the 1970s, you could expect to get about 5% on a treasury note. And this is pretty much just a single gold line because there's almost zero probability that you're going to get anything else. So there's no spread along the x-axis there. And another thing, let's contrast this treasury note investment with a couple of other investments. For investment A, it could be something like a high yield bond or just a pile of high yield bonds that we've put together. And the first thing to notice here is that the average return that we'll get for that bond or those individual bonds is higher than what we've got for the treasury. But now look what's happening. Now we have a distribution of returns. So sometimes if you buy a pile of high yield bonds, they're not going to do very well. And you might get on average a loss of 10% down here or even more. On the other hand, if none of them magically default, you may get a wonderful return like a 40% return, something like that. And now let's look at a third investment, which could be a stock or just a random pile of stocks that we've put together. And you see here that the average return for this pile of stocks that we're putting together, or one stock that we keep investing in year after year after year after year, the average return is higher now than for high yield bonds, and it's also higher than the Treasury note. But now look at the spread, look at the distribution of returns here. We could have very big losses, right? And we've seen this type of thing in the marketplace recently, speaking in March of 2021, where the extreme tech high flyers, some of them have just crashed terribly in the past month or so. And on the other hand, if everything goes our way, we might get really, really high returns, something like what the ARKK ETF got in the year 2020, something like that. So the basic takeaway here is it looks like if you want to get a higher return on average, you have to increase your risk. Your risk is going to be measured by how big is this downside tail, right? How far can we go over here? And we can measure that by standard deviation or probability of loss or value at risk or something like that. So let's formalize this a little bit on the next slide and think about how could we reduce our risk of returns. Well, on the last slide, the approach was to say, well, if we really want to decrease our risk here, we want to decrease the standard deviation of returns. Or again, looking at that left tail of the distribution, we could say we want a small probability of loss, or again, looking at the left tail, a small value at risk. And the bad news about this, as we saw on the previous slide, is that in every case that reduces our expected value return. Highest expected value return, biggest tail over here, biggest standard deviation, biggest probability of loss, right? And with our high yield bonds, we have a lower expected value, but the nice thing about that is we have a tighter distribution and less probability of a very big loss in particular. Also, of course, less standard deviation of returns. And if we go all the way to the Treasury, unless the United States government blows up, which hopefully is a very small probability, we're absolutely going to get just what the contract says. We're going to get the promised amount. However, there is another approach that is much more exciting. We can invest in a diversified portfolio of projects with the emphasis on diversified. And what we mean by that is a portfolio of projects or investments that are poorly correlated to each other. And we're going to measure a correlation mathematically, but just qualitatively, if two stocks or two bonds or a stock and a bond move in price up and down together, they're highly correlated. If they move up and down in price opposite of each other, they're very poorly correlated. And the beautiful thing about this Plan B approach is that this strategy is going to reduce our standard deviation of our portfolio. This is going to reduce our portfolio returns standard deviation, but will not reduce the expected value. So it's sort of like magic, okay? And caveat here, correlations have to remain static, which isn't always quite true, but we'll get to that later. So this is, in good times anyway, a true free lunch. And a lot of people say that the single free lunch in finance is diversification. So very helpful, very important. So now let's think a little bit about diversified portfolios of projects versus undiversified investments. Let's just kind of classify projects or investments along the lines of diversified versus undiversified. So I've got our little table here, investment type, example of this type, and is it diversified? Yes or no? Okay, so if we look at a single project, we've looked at a lot of single projects this semester, something like we buy shares of Tesla or we make a loan to the Kia Corporation. These are never going to be diversified. A single project can never be diversified because all of our eggs are in one basket. In fact, we only have one big egg in our basket, so if we drop that basket, we lose it all. So you heard it here first. Within 5 to 10 years, when hydrogen power comes to overtake battery power because it's superior in every way in 5 or 10 years, Tesla will either have to convert itself to a hydrogen-powered car company or get squashed like a bug and die. And similarly, Kia Corporation could go bankrupt. There's all manner of car companies that have gone bankrupt. Okay, let's look now, let's contrast that to a portfolio of projects, but now this is going to be similar projects. Okay, so what do we mean by a portfolio of similar projects? Well, portfolio means a bunch of projects, right? And similar is going to mean something like this. Let's say we have a lending company and all we do is make loans to 5 property management companies in Oxford, Ohio. Is this a diversified portfolio? No. And the reason why we could see again in the COVID crisis is that virtually all of the property managers in Oxford, Ohio are focused on student housing, and the student housing demand completely collapsed in COVID. So if we had made 5 loans, very high probability that all 5 companies could have gone bankrupt during the COVID crisis. So even though we have a portfolio, we have a bunch of projects, because it's not diversified, it's not really very good. So let's see if we can do better. Let's look at a couple examples of portfolios of dissimilar projects. So a simple example would be, let's buy one stock from each S&P 500 business sector. In the S&P 500, there are 11 sectors, including finance, energy, communications, consumer discretionary, consumer non-discretionary, stuff like that. So if we bought, for example, Google and we bought GM would be consumer discretionary, et cetera, and we bought 11 of those, then we'd be kind of diversified, right? Because it's not necessarily true that the medical industry, which is one sector in the S&P 500, is going to be doing very badly in a recession when consumer discretionary companies like GM are going to be doing badly. So that might help us. And now let's see, though, if we can do even better than that. How about if we do something like buy a share of the SPY ETF? Now, the SPY ETF, as we know, gives you, if you buy one share, that gives you fractional ownership of 500 companies in the S&P 500, drawn from the 11 sectors. So of those 500, you have about 90 each, or whatever the math works out to be, in each of those 11 sectors. So because we have all 11 sectors, and now we have so many stocks, not just one in each sector, now we're really very well diversified. So to see more on the importance of correlation, we can see another graph that we've seen before, but if we map on the x-axis of this graph the number of projects in our portfolio, and on the y-axis portfolio risk, which we could say measured by sigma, our standard deviation of returns, VAR, etc., doesn't really matter. What we see is that as we add more eggs to our investing basket, our risk measured by standard deviation, VAR, whatever we want, does come down. We can't reduce it completely, right? Because if there's a huge macroeconomic shock or something, that's going to hit all assets, but we can reduce it a lot. And the key thing to remember here is this does not work if our projects are undiversified. So we're going to be looking at correlation first and foremost to help us build diversified investment portfolios. That's going to be first and very important in that lecture, and we're doing that to grab that one free lunch in finance. The second thing that correlation helps us with, and helps a lot of mutual fund and hedge fund portfolio managers with, is to understand how the returns of an individual stock compare to the returns of the overall stock market. So first, what we're going to do is look at some measures of correlation. Then we'll see how to use those measures to build diversified portfolios. And then we'll look at how we can use measures of correlation to understand how the returns of one stock compare to the overall market. So let's get started with mathematical measures of correlation. There are two important ones. The first one is the correlation coefficient, which we'll talk about now. The second one is beta, which we'll talk about in a few minutes. And the correlation coefficient, which everybody calls rho, Greek symbol, small case rho, measures how much two random variables tend to move together, ignoring amplitude effects. And if we're looking at the returns of two stocks, say X and Y, we typically say rho XY, and that means the correlation of X and Y returns. And here we have a hairy formula showing how to compute the correlation coefficient, and you don't need to know this. This is just to show you that it's true, it's true, it's really true. There is a mathematical way to compute correlation coefficients. We're going to need a whole bunch of historical returns for stock X and stock Y to make that happen, but we could do it. The more important thing that you do need to know is what's shown in this table here. This shows us how correlation coefficient rho works. All right, so this table is important. So if two stocks tend to move identically, or two exchange-traded funds, either one, tend to move identically, they'd have a correlation coefficient rho of 1. So an example of that might be something like the SPY ETF, which aims to follow the S&P 500 stock index, versus the S&P 500 index itself. And there's very, very little what we call tracking error in the SPY versus the S&P 500. So the correlation coefficient between those two really is pretty much 1 or 100%. So if we have the returns of two assets that move opposite to each other, they're going to have a negative correlation coefficient of -1. So this is going to be the range of rho from +1 to -1. Is there a real world example of that? Yeah, there are things that are pretty close. For example, if we look at the SPY ETF versus the SH ETF, we get something close to -1 because the SHTF is designed to perform exactly opposite of the S&P 500. Okay, so when we see something like that, whenever we have a negative sign on our correlation coefficient, we say that the two assets are negatively correlated. So when the SPY is going up, the SH is going down, and vice versa. And another important possibility for our correlation coefficient is 0. Remember, the range goes from +1 to -1, so it's going to pass through 0. So 0 is important, and 0 means that the two assets, the two stocks, the two ETFs we're looking at move independently. And in that case, we say they are not correlated or they're uncorrelated. So a real-world example here, this is not perfect, but it's pretty good, would be to compare the XLK exchange traded fund versus the XLV exchange traded fund. The XLK exchange traded fund includes about 12 big high-tech stocks. So it's got Microsoft in there, it's got Google in there, stuff like that, Facebook in there. And XLV has 12 large healthcare stocks, things like Procter & Gamble, etc. And really what goes on in tech is not in just about any way correlated to what goes on in healthcare. So their correlation coefficient is close to 0. Okay, so here are some graphs of what correlation coefficients can look like for the returns of stock X versus the returns of stock Y. The thing to note about these graphs is that this author, instead of calling correlation coefficient rho, is calling it R. Almost everyone uses rho. Some textbooks use R, and as usual in finance and accounting, we just have to suck it up and deal with that. We're going to use rho exclusively. Okay, but what we've got here is a rho of -90%, and you can see what we've got plotted here are returns for X versus Y. So this would be the return of X on the X-axis and the return of Y on the Y-axis. And you can see it's pretty close to a 45 negative degree sloped line there. And now we have something here where the correlation coefficient is -50%, and you still see we sort of have this trend line going on here, but it's not followed nearly as closely as our trend line here. It's a lot looser. The data is a lot scattered. And here we have a correlation coefficient of 0, where I would say you'd have to be pretty brave to draw a line through that. And I would say both of these lines that I've just drawn are equally bad. So this would be, we'd say here, it's virtually impossible to predict the return of stock Y based on the return of stock X. And we can do the same thing with positively correlated asset returns here. So I'll let you look these over yourself. R equal positive 0.5, R equal 90%, or rho, as we're going to call it, and rho equals 1 would be a perfect straight line from X to Y. And here I just want to show you that it is possible to compute rho, and so I've got some data on the returns of stock X and stock Y, and I've just got 4 periods here. In the real world, of course, we'd want 30 or more periods, but I just literally didn't want to drive myself crazy computing this, and I wanted something easy to show you. And so I've got my formula here, and you can see over here, if you want, you can check it out, how I did get to the correlation coefficient from this. So this is just to show you that we can compute rho from returns of X and Y. Again, I'm not going to ask you to do that, but it's possible using this formula up here. And those of you who are super interested in statistics might want to check my work on this one.